How should I read what the market is telling us today? Are investors saying, yes, we know the tariffs went into place today, but we're not that worried that this is going to turn into something much bigger?
Well said. I think that's exactly what they're saying. And if you look at what's been moving in the markets, it is things that are going to likely avoid any sort of trade war ramifications. We're going to see these small caps continue to do well. They've done very well. Stocks that benefit from a stronger dollar have done well. Our energy companies have done very well. And if you look at our multinationals, they haven't done quite as well. The large caps haven't done quite as well. What the investors are telling us is they like America theme, American stocks. The dollar is strong. And look, the Dow has held ground at the 200-day moving average. The S&P 500 has held ground. We have the NASDAQ and the Russell at or near all-time highs. This is a much better market than it feels. It feels bad because all we hear about is trade wars. But if you look at the actual action of the market itself, it's fairly healthy and it's very resilient.
Chad, when we consider the jobs number this morning, clearly the market liked it. What do you expect the Fed to take away from it? Does it derail hikes? Does it encourage hikes?
It's more of the same. They're going to continue to raise rates. We believe an additional 2 times in 2018. When we look at 2019, we're thinking about another 2 times. We think that perhaps the terminal rate is between 3 and 3.25%, and they're going to continue to draw down liquidity off their balance sheet. That could potentially be a headwind overall for total return for risk assets, in particular on the S&P 500. Yes, the United States is growing quite nicely, but the global growth scenario is not synchronized like it was back in 2017. And yes, this trade war issue today does not play a major role in earnings for next quarter, but going out over the next 3 to 4 quarters, you may have additional concern about additional revenue growth for multinationals.
Jim Lacamp, what do you think about the employment data that we saw today? Does it ease any concerns you might have had about whether or not the Fed is going to get too aggressive?
I don't think the Fed's going to get too aggressive here because what we're doing here is normalizing interest rates, and we've needed that for quite some time. Ultimately, that should be healthy for the banks. The jobs picture has been really strong. We've had no worries there whatsoever. And a lot of people are now bringing up this inverted yield curve issue. Look, if you look at the history of inverted yield curves, you have a long wait between the time when the yield curve inverts and it really impacts the market or even leads to recession. That suggests we have another year or so of growth in front of us, both in the markets and in the economy. And if you look at earnings moving forward in this quarter, the next quarter, 2 quarters out, 20% earnings growth. There's not a lot not to like here. Bear in mind that valuations have compressed. We've had a market that's well off its January highs, but in the meantime, we've had 2 quarters of very solid earnings growth. So valuations are more compelling now than they've been in several years, actually.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.